All right, everybody. Stocks by the numbers. Welcome back. And it's Wednesday. I know we have the Fed meeting coming up. It's about 1 in the afternoon here, but I wanted to go over a couple of companies because we're in earnings season still, and we have a lot of action. So let's take a look at it. Full disclosure, earnings are 100% a gamble. Please understand the risks involved. First company we're looking at, Qualcomm Incorporated, ticker symbol QCOM, listed here on the NASDAQ. Stock right now, $164 even, down $1.85, about 1.1% here on the day. And overall, in my opinion, I personally always like Qualcomm. This is a pretty decent tech stock, semiconductor company, and even looking at the numbers here, in my opinion, I actually think it's undervalued. We have a market cap here a touch over 183 billion. We're getting paid a dividend yielding a little over 2%, and we're trading roughly 24 times earnings right now. The EPS has been stable over the last 4 quarters with a really nice beat last quarter, beating by about 16%. And we can also see that the revenue on the company actually came down from 22 rolling into 23, and you can see we're dropping into the low 9 billions, 8.5 billion with a slight miss, and then we bounce back here above an $8.5 billion estimate, and then as of last quarter, estimates chunked back up on the revenue side to over 9.5 billion. The company posted almost 10 billion and beats that number by about 4.33%, and again, a nice healthy beat on the profitability side as well, posting 275 on estimates of 237. So overall, in my opinion, the company right now trading about 6 times annual revenue as of 23. But again, with the PE of 24, and the company for the most part being pretty solid when it comes to earnings over time here. We can see, looking back at the revenue side, 2 slight misses here over the last 8 quarters, in my opinion. Pretty stable, and chances are, again, that's why here at about 9.35 billion, I'd personally give them the benefit of the doubt and probably consider calls on Qualcomm today after market close. If we look annually, the company hasn't missed on annual numbers here, going all the way back to 2016. EPS has beaten for 8 quarters in a row, and switching over here annually, beaten every year going back to 2016. So in my opinion, you probably, chances are, again, anything can happen, but chances are you probably have a decent chance with something like Qualcomm, but we could drop at any moment. Carvana, I drew these trend lines out here a while ago. This is going back from like the lows here of inception in 27, that all-time low there, March of 20, and just drew those across, and you can see this top trend line here, it actually got up to it, started to reject, and probably could have filled the gap, honestly, to about 62.75, but happened to bounce there and then spike back up. And the problem with Carvana is, I understand it was a potential short squeeze play, and the stock really exploded here, as you see, going from mid-single digits here. Look at this, sub $5 here. We have a 52-week low of less than 7 now, but you can see the stock ran all the way up to about 94 and change, as you see there, new high 94.04, and we're still sitting here at 83.70. But if we look at the earnings, they do look pretty sporadic and pretty inconsistent here. We have 3 misses in a row there on the top and bottom line, and then we come back with a beat on the EPS, but we miss on revenue. Now we finally beat on the top and bottom line, and then we miss on revenue again right after, and now as of last quarter we miss on the top and bottom line as well. So I understand the stock is up, and people were talking about the potential short squeeze, and obviously the stock really exploded here over about the last 12 to 15 months. So if you were involved, of course, congratulations. I hope everyone's doing well. But just looking at the numbers here, in my opinion, it seems like, based on past results, and again, past performance does not dictate future results, but in my opinion, looking at how this company reports earnings, Carvana right now, symbol CVNA on the New York Stock Exchange, touch below 84 here, up about a point on the day, but here on a loss of 67 cents a share and revenue estimates of a touch below 2.7 billion. Even though we could potentially make the argument that it's undervalued, looking at the annual revenue to market cap comparison, we are still trading here with a PE well over 100, and in my opinion, the earnings are just very sporadic. And also, I feel like the whole COVID lockdown, massively overinflated car prices that screwed everyone over. In my opinion, I think that time has done, and now everything, that time is done, it's gone. But overall, in my opinion, these prices are now coming back down to earth, and anyone who probably needed an automobile probably grabbed one already. So, in my opinion, I would actually personally lean towards Carvana puts. We'll look at Etsy real quick. Etsy tech name in the space, of course, internet retail, and we can see, is that even a proper Trend line? Yeah, no, it's like that. Yeah, it's funny, sometimes I draw out these trend lines and then, as the stock moves, sometimes when I put the log on or take the log off, it readjusts the trend lines, obviously, and sometimes I forget even the patterns I was looking at. But we can see that we were in this kind of long-term descending pattern. I guess you could make the argument that it's more of a wedge potentially as opposed to a descending triangle, but we can see now as of late we just actually ticked up above that trend line, probably on anticipation of these earnings. And Etsy right now, symbol ETSY, stock sitting here just a touch over 69 and a quarter. It's up about 60 cents, 0.9% here on the day. We have a market cap 8.1 billion, we'll call it, and we're trading about 30.5 times earnings. So last quarter we can see the company actually missed by a chunk on the EPS side. Before that was pretty solid, and now we can see EPS estimates drop back down to 48 cents, which we only had one quarter lower than that EPS estimate going back all of 2023. So I'm curious to see how the company reports on that profitability side. But we can see that the revenue does seem pretty stable for the most part for the last couple of quarters here. Before that, even when we have our EPS misses, we can see that the company somehow, some way is able to come in above these revenue expectations. Now, I understand it does kind of bounce around from quarter to quarter, and we can see that it looks like Q4 seems to be their best quarter. This time last year, the company brought in just a touch below 641 million. Now we have estimates of 646.299 million. But let's just check the annual numbers here. We can see we are basically consistently growing here over the years, up to about 2.75 billion for 2023, which would bring us to about 3 times, a little over 3 times annual revenue. We're trading 30 times earnings. Let's see, let's go back. Yeah, we can see quarterly revenue numbers have been good. On the annual side, the company has been coming in above these expectations, forecasting continued growth. Again, EPS may be an issue here. And on the annual side, we can see that we had a wider than expected loss here to close out 2020, and we can see in 23 our profitability missed by a touch below 6.5%. So believe it or not, right now, in my opinion, we could potentially make the argument that it is fair valued or maybe even undervalued, because I know we could view maybe a PE of above 30 as a little bit high. However, again, this is, website selling to consumers and whatnot. So we could, of course, pump the numbers up a little bit more than the industry average. But in my opinion, I would actually say puts on Etsy. I just have a personal feeling that they may miss again on that EPS side, and the stock may end up coming down over time like we saw here last quarter, as opposed to popping up and breaking out of this wedge. And if we do come down here to the bottom of this channel, we could be looking at maybe around 57.5, I'll call it. So in my opinion, I would probably personally lean more towards Etsy puts there. We're looking at DoorDash real quick. DoorDash has been on the up and up. We are now in the stage of convenience, and we basically want everything delivered to us. And we can see similarly, the company missed big on the EPS side last quarter, but beats on the revenue side by about 2.33%. Beat on the top and bottom line there. That's my keyboard again, piece of crap. But we can see miss on the EPS side before that, beat on the revenue side, beat on the top and bottom line, miss on EPS, beat on revenue, miss on EPS, beat on revenue, miss on EPS, beat. So in my opinion, it seems like the revenue is consistently coming in for this stock. But let's check the numbers here. We have a market cap of 51.5 billion. This company, again, runs an app basically delivering people stuff, food, what do they also, they do everything, I believe, DoorDash. But right now, 51.5 billion. The company's losing $1.42 a share. EPS is on the up and up, but just had a big miss last quarter. Revenue has been climbing nicely to close out 2023, 8.64. So we are trading about 5.5, 6 times annual revenue. I just personally don't like the fact that they're still incurring losses here, even getting above this $2 billion mark. And we can see that on 0.14, 140 million roughly, on 140 million more revenue, the company actually incurred twice as much of a loss here, quarter over quarter. See, I don't know, a situation like this, because it is on the up and up, because everyone just looks at, like how many active users are on the app, and of course what they're potentially forecasting. But in my opinion, it went on a massive run for a stock that is still EPS negative and does seem very, very sporadic, in my opinion. I mean, we have a lot of EPS misses here along the way. And again, I know sometimes I personally say even to follow the revenue, but here on a situation like this, again, I mean, they've been established for several years and the revenue consistently keeps climbing. And again, now we're up here at 8.6 billion as of last year. And 5 years ago, the company was doing 10% of that revenue. So this is what I mean. On these growth years to bring the stock up, of course, it was overvalued, in my opinion, coming out of the gate like the rest of them. But you can see we tanked it down, and then we've basically been up since October of 22, right? So we're talking what? Over a year and a half, technically. About a year and a half, right? So for 18 straight months, this stock has been on the up and up, going from 40, getting up to north of 140. And again, technically, over the last couple of quarters, it seems like the losses are remaining, if not potentially widening here as of last quarter, even though I know revenue is up. And I'm sure people are going to say, well, they're expanding this network and that network, whatever. I can appreciate that. But again, in my opinion, just looking at the situation, I think we pull back to about here, this fib conservatively of about 109, in my opinion. I would say DoorDash puts, personally. Now, MGM, in my opinion, this one may be a difficult one to call because I personally spoke about Boyd Gaming, which I like personally in the long term, and Boyd happened to miss earnings and the stock chunked down. And then yesterday, I saw Caesar Entertainment, CZR, reporting earnings, and I basically fed off the report that we got from Boyd, and I tweeted out, in my opinion, CZR puts. And Caesar happened to drop after earnings report yesterday after market close. So now with MGM, it does seem a little rough because I know this is probably one of the more brand name, more well-known names in the space. And the stock has been pretty consistent. But if we check the numbers here, market cap 12.6 billion, PE of about 12.5. EPS has been climbing nicely, had a really nice quarter last quarter. 359, 387, 94, 97, 438. So revenue is on the up and up. Net margin took a hit, but it's beginning to rebound. And over the years, we can see 12.9 here before the lockdowns, dropping down to 5, almost 10, 13, now back up north of 16 billion. So they have gotten back to above where they were significantly, looking like about 25, 30% above the revenue they were bringing in back in 2019. And what are we expecting here? 56 cents, 4.2. 4.2. In my opinion, perhaps MGM, I would give the benefit of the doubt here. In my opinion, I would probably give MGM the benefit of the doubt, and I would be looking for probably a revenue beat here. And again, EPS the last couple of quarters seems to really have turned the corner, and the company seems right now, in this moment, they seem to be back on track. So, in my opinion, with the stable revenue coming in, and again, over the years, you can see going into and during that lockdown was really the only time the company ran into an issue with the revenue. And on the profitability side, of course, it does really seem hit and miss. We can see for the year, the company only came in above estimates 3 of the last 8 years. But on the quarterly side, as of late, in my opinion, it does seem pretty stable. And it looks like they're forecasting to maintain above this $4 billion revenue mark here, quarter over quarter moving forward. So, in my opinion, I'd probably give MGM the benefit of the doubt, and I would personally lean towards MGM calls, in my opinion. First Solar, excuse me, First Solar is a stock that I feel really swings around, obviously, and, sometimes we have some good quarters and sometimes we have some bad quarters, obviously, but the stock really can move depending on what the company says. But we have a market cap here, 18.8 billion. The company's trading a touch below 23 times earnings. We can see the EPS has been on the up and up, now expected to pull back to about $2 a share. Not seen since back in July of 23. And annually, we can see, you know, we're kind of stepping around, but for the most part, it seemed like we were stepping down. And now 2023, revenue jumps up to $3.3 billion, which is the most going back the last 5 years. Net margin 25% now. That's the best it's been going back the last couple of years. And if we look here quarterly, we can see the revenue really did chunk down, but really started to accelerate and come in towards the end of the year. So Q4 was $1 billion. Now we're up to 116. They did 548 million this time last year. Now we're up to 718. 718. Revenue does seem pretty inconsistent, and this was this time last year. Again, estimates were up into the 7 and the teens, as you see here, 713.8, estimates 718.2, and the company comes in and posts 548 million. Now, of course, since then, the revenue has started to chunk in, but we can see they actually missed on those revenue numbers 2 of the last 3 quarters after the rough Q1 this time last year. So, in my opinion, I might... 18.8, trading about 6 times annual revenue on sporadic revenue with a lot of misses. In my opinion, I would personally lean towards First Solar puts here, FSLR, right now, over $175 a share, in my opinion. FSLR puts. Now, one of my favorite meme stocks that I always get attacked when I say the stock was going back to 6, even though it did. People try to tell me I'm clueless. But ENVX Corporation, ticker symbol ENVX, listed here on the NASDAQ. Now, someone jumped down my throat because on the update, I didn't re-mention the Routejade acquisition that was originally mentioned in the initial video analyzing the company. And of course, the last video was just an update, updating you guys on any new news and any price that the stock hit that we were looking at. And as we see here, ENVX right now trading at $6.39 a share. It's up 13 cents, about 2% here on the day. Earnings due out here after the close, expecting a loss of 31 1/3 cents a share on revenue of 3.772 million, a whopping 3.772 million. My amazement, quote unquote, that I was called out for on supposedly last quarter was the fact of how much they came in above these expectations, right? Because if we knew the Routejade acquisition was going to take place, then this estimate, in my opinion, probably shouldn't have been this low if the company was able to post over 7 1/3 million for this quarter. So estimates, in my opinion, probably should have been at least between 6 and 7 million if we understood the Routejade business. But estimates were extremely lowballed, in my opinion, at 3.1 million, and the company beats by over 137% on those estimates. That's where my amazement came from. Yet, at the end of the day, it didn't matter because your boy was correct the entire time, and you guys pumped up a stock coming out of COVID with the stimulus money, and the stock tanked from 12 and change to new lows, dropping over 50% as of about a week ago, and now has gained a little bit of momentum going into these earnings. 3.77 million. Market cap here around $1 billion. I said last time when I updated with the stock at these lows here of 6, I said that in my opinion, I do agree with you guys that there is potential long-term value here, and I would personally consider beginning to piece my way excuse me, too much coffee. I would personally consider piecing my way in at around $6 a share with the potential to pull back to about 4.5 on this trend line here. And in my opinion, I do think it pulls back again because, as I mentioned last time, even 7 million, if we extrapolate that over 4 quarters, you're talking about 28-30 million. Even if they make 40-50 million, we have a market cap still up here at 1.08 billion. So this company is trading, 15, 18, 20 plus times annual revenue now being brought in from this Routejade acquisition, and we can also see losses are accelerating and widening even though they're coming in above expectations. And we can see now, even again, like I said, even with the company bringing in whatever they say, 40, 50, 80 million for the year, in my opinion, it's still overvalued, which again is why I said, if I wanted to personally take a position here, I would possibly begin piecing in here. And then today, if they report earnings and they happen to drop, 20% and make new lows, in my opinion, I would not be shocked. I would not be surprised. In my opinion, it would be 110% justified. And I would personally possibly add to the position pending on what the company reports here, especially if they're not laying out any really big future obstacles to come over the next 3 to 6 months, over the next couple of quarters, where we could potentially see a fair valued stock with potential nice earnings beats over the next 1 to 2 quarters that can rally us back up to maybe the 7s, the 8s, and the 9s. So that's how I feel about ENVX. I've spoken about this stock on multiple occasions, but I just had to make sure to mention the revenue coming in is from the Routejade acquisition, because I don't want to be called clueless again. And if this stock drops back to this trend line here of sub 4.5 and hits new lows, obviously you were warned. You were warned, in my opinion. Here we're looking at Allstate, right? Insurance company. We know that premiums have been going through the roof, and specific companies are benefiting from the rough economic environment that the average consumer is dealing with right now. And of course, the few companies that are benefiting are credit card companies and insurance companies, right? We've seen this, especially with stocks like Visa posting, record high profits and revenue, and there's record high household debt when it comes to credit cards. But here we're talking about Allstate, and we can see the stock has really been on an absolute tear for basically about the last 12 months straight here, going from the low 100s, getting up to 176.93 as of late. Allstate right now, symbol ALL, listed here on the New York Stock Exchange, 172.5, up almost 2.5 points here, about 1.5% here on the day. $45.5 billion market cap, dividend yielding out 2.16%. The company's still losing money per share right here. Look at that beta, though, 0.18. Again, the beta is the volatility of the stock in relation to the overall volatility of the market, and this stock is technically 0.2 as volatile as the overall market. So this is why, in my opinion, a good long-term grower here. Look at this over time here. I mean, we have phenomenal growth, and this is capital appreciation on the principal investment, on top of which you're getting paid a dividend to own it. And of course, if you drip the entire time, DRIP again stands for Dividend Reinvestment Program. So if you drip the entire time, this is known as compound investing. And a situation like this, if you invested in 3-5 years ago, chances are you would be up significantly well right now. And we can see that, oh, look at this, the revenue just consistently keeps climbing quarter over quarter like clockwork. Reason being, again, is because one of the few people who are benefiting from this are insurance companies like Allstate. So in my opinion, again, I know the company net income negative. They brought in $57 billion for the year. We got a market cap $45.5 billion. It honestly could go either way. And we can see that up until last quarter here, only a miss of 0.4%. But before that, the company beat on the revenue side 7 quarters in a row. So with a company like Allstate, it seems like the profitability is more of an issue. However, we can see that even though we were seeing EPS misses ranging from about 6% up to north of 23% at times, look at the U-turn that this stock has made over the last 2 quarters here on the profitability side. So in my opinion, these revenue estimates of about $12.75 billion, probably in line with what the company is going to post. And $3.93 a share, essentially the same EPS estimate that we saw last quarter. In my opinion, I would actually give this company the benefit of the doubt, and I would personally consider calls on ALL, again, that is Allstate Insurance. There was maybe 1 or 2 other stocks. I wanted to look at Zillow as well, because Zillow got pumped up, of course, during the real estate boom. And here, about the end of the summer, as you see, about August of 2023, that's when myself and a handful of other individuals, shout out to the crew in the Discord, got a great community going, in my opinion. Really a great group of guys and girls in there. And we were looking at Zillow, and we were potentially talking about the real estate boom and the real estate hype coming to that tip and potentially dropping off a cliff about that midway point of 2023. And I personally was looking for it back here in like July, and you can see technically I was a couple of weeks early, and the stock continued to run up to about 57, it looked like, and then we began to break out of the rising wedge, and we consistently stepped down to these trend lines, immediately dropping to sub 50 Puts were mentioned here in the Discord at this time. We had a handful of people make some decent profits. You can see we came up to retest the top trend line here and then rejected hard, and the stock went from the mid 50s back down to the low 30s, and then of course made a nice recovery and has recently been chunking down. So in my opinion, overall, I think the hype is done, and I think because the stock was taken up so high that it was potentially viewed as overvalued, which is why when the markets ran into some volatility, something like Zillow really started to chunk down, and you can see this was about 6 weeks ago. Big volume came in, huge red day for the stock, and we began chunking down. Honestly, I'm not sure offhand what the news might have been in that moment, but in my opinion, I would probably lean towards Zillow puts here, believe it or not. Stock right now, ticker symbol Z, by the way, listed here on the NASDAQ. Stock 41.85 a share, down about 3/4 of a point, about 1.7% here on the day. We have a market cap still sitting at a touch below 10 billion. This company is losing money per share. Again, they run a website that lists houses, and then they take a commission, but somehow operating this website is losing them money. And yeah, it's situations like this that throw me for a loop sometimes, because again, even something like an Allstate to operate at a loss does kind of blow your mind a little bit, but we can agree that that's probably a little bit more of a complicated business than operating a real estate website. And that's why, like a year ago, I used to personally beat up a company like DraftKings, right? If we look at DraftKings, this is a company that runs a gambling website, but you're telling me they're not making money. That is essentially an oxymoron if you really think about it. So that's why certain companies, when I see negative EPS, I of course initially get that red flag raised. And believe me, I know it could be a slew of different circumstances as to why a company is operating at a loss. But here, in my opinion, especially after the real estate boom, I would just personally think that something like Zillow would be EPS positive by now. But we have a market cap a touch below 10 billion. Again, the company losing about 68 cents a share. The EPS was on the up and up, recently took a chunk down. However, they have been coming in well above expectations, and we can see EPS estimates now expected at 31 cents a share on revenue of a touch over 508 million. And you can see, look at that boom. Look at that boom in 2020. In 19, we were at 274 billion. In 2020, their revenue jumped up to 3.25 billion. And then immediately the year after, 2.1, and then sub 2. And then for 2023, 1.95. And of course, the net margin dropped even further, going from a little over -5% down to a little over -8%. And if we switch over quarterly, you can almost see the plateau there at 506, and then we've been pulling back in revenue for the last 2 quarters with our losses widening as well. So in my opinion, for the estimates to go back up to 508, this was Q1. This time last year, the company brought in 469 million for the quarter, which is almost exactly 10% growth in revenue that they're expecting year over year. And in my opinion, personally, I think the hype has died down in the real estate market, and this stock here, even after suffering some potential losses here as of late, if we really want to view them as negative, the stock is still trading at about 5 times last year's revenue, with future revenue, in my opinion, potentially looking to go even lower. So I would personally lean towards Zillow puts here. I also wanted to look at eBay. eBay has been more solid and stable than people think. We know, hearing about a lot of these side hustles, and what we're hearing, with a company like eBay, similar to what we're hearing with Amazon, is that a lot of people will do a lot of reselling, or they'll potentially, go on a site, maybe something like a Temu or something, and they'll look for any item really that they can buy in bulk, which of course will lower their cost per unit, and then they'll take the time to individually package and separate these items and then resell them on sites like Amazon and eBay. So that's why, in my opinion, eBay has been maintaining this revenue. As you see, about 2.5 billion. We have a market cap right now a touch over 26 billion. We're getting a dividend yielding out 2.1%. We have a PE single digits here, a touch below 10. And look at this company here earning 5.25 per share, right? Because they're earning earning a slight commission off of each listing. So it's funny because it's essentially Zillow, but it's a bunch of random items as opposed to houses that are worth hundreds of thousands and millions of dollars. Yet somehow eBay is generating 5.25 per share and Zillow is losing 70 cents a share. But in my opinion, I always liked eBay. It does seem like a stable, solid business. Again, especially in this economy and this environment, based on what the company could bring to the table for someone, again, doing a potential, side hustle. But we can see EPS climbing up here. This is now the highest estimates here going back the 4 quarters of 23. EPS estimates coming in here, $1.20 on revenue of $2.534 billion. And we can see, again, maintaining this revenue here, climbing up to $88 billion in 2020, up to almost $10.5 billion in 21, down to $966, back up to 10. And look at that net margin percentage to close out 23, over 27.5%. In my opinion, phenomenal. But look at this revenue here. Look at how stable, 242, 248, 253, 25, 255. So this is why, again, to stay in that range, 253, in my opinion, I would probably give them the benefit of the doubt. And right now, again, at $10 billion for 2023, the company right now is trading about 2.5 times that annual revenue, trading less than 10 times current earnings. So in my opinion, I would say eBay is potentially undervalued, and I would give them the benefit of the doubt, and I would personally consider eBay calls, in my opinion. MetLife, another insurance stock here, symbol MET, listed here on the New York Stock Exchange. Stock right now, 71.81, up about 0.75 point, about 1% here on the day. We have a market cap of a touch below $52 billion. We're getting paid a dividend, yielding out 3%. But this one has a PE up here at almost 39. But again, we have a beta of less than 1. So these insurance companies, in my opinion, may be a sector you may want to keep an eye on here for the longer term and potentially step in and buy these dips on some of these insurance stocks. But we can see EPS has been kind of mixed on this one. 2 beats, 2 misses over the last 4 quarters. And we can see the revenue has actually been stepping down over the last couple of years, breaking below $67 billion, which is the lowest it's been going back the last 5 years. However, as of last quarter, we can see revenue chunked up to over $19 billion, going from that $15-16 billion range. And now estimates here at $17.72 billion. So even though this company may look a little more rocky when compared with the other insurance stocks, in my opinion, even with the PE up here, I may actually personally lean towards calls on MetLife, MET, in my opinion. The last couple of quarters have been really solid here, and it looks like we're going to continue this next milestone of revenue here, up here at 17, 18, even 19 billion to close out 24 potentially forecasted. Now again, the EPS side has been rough, and technically they've, I guess, haven't been growing at the same rate that Wall Street is anticipating. But usually I've seen a situation like this where we could potentially have that pause moment, and this could be the potential transition year back here in 22, getting much, much closer to estimates in 23, and now potentially having the ability to come in above estimates for 2024. So in my opinion, again, based on the environment and based on the few sectors that are really benefiting from the hyperinflation and the rise in cost across the board, I would probably personally lean towards calls on MET, again, that is MetLife Insurance Company. There are a lot of other stocks here, and I'm just not sure like how deep to go down this list. I have the earnings whisper calendar, of course, on the top screen here. I know you guys can't see it, but Avis recently started chunking down, really exploded coming out of 2020. Again, people love their cars, right? But we can see as of late, revenue has really chunked up, but they have been missing on these estimates. Now estimates back down here at a touch over $2.5 billion. Company expected to lose over $2.93 a share for this quarter. Avis Budget Group, ticker symbol CAR, CAR, here on the NASDAQ. Stock right now about 94 3/4, down 67 cents, about 0.7%. Recent price target, Susquehanna, lowers from 145 to 117. So, I mean, that's still a little bit of upside, but market cap $3.33 billion, PE 2.25. EPS has been bouncing around, but they've beaten for the last 4 quarters in a row. Avis seems to be seeing some really nice growth in revenue here over the last couple of quarters. Excuse me, over the last couple of years. But we can see Q4 of 22, 277, Q4 of 23, back down to 276 with the net margin dropping about 40%. 277, 276. Q1 coming in 256. Estimates 252. So they are expecting a dip down in revenue, and of course the net margin is probably not going to be plus 12.2%. So in my opinion, I would actually lean towards puts on CAR, on Avis, in my opinion. Let's see, what else do we have here? Upwork. Something like Upwork, I understand they're like slowly ticking up, I believe, the last time I looked at it, on the revenue side. $1.5 billion market cap, trading over 200 times earnings. EPS has been on the up and up, 4 beats in a row. And yeah, you can see the revenue slowly stepping up. Up here, estimates touch below 186 million. I mean, I know this is an outlet for a lot of people to do some freelance work and generate some, some extra income for themselves. I mean, this would technically be the highest estimate, again, going back like the last 5 quarters. Let's look at their history real quick. And we can see that on the EPS side, they've been doing well. On the annual side, revenue side, doing well. And we can see only a slight miss back in 2019. So based on past performance, and again, past performance does not dictate future results, but they have brought the stock down here and consolidated it in this channel since last earnings coming out about around Valentine's Day. So in my opinion here, I would potentially consider giving them the benefit of the doubt. And Upwork, ticker symbol UPWK on the NASDAQ, right here, a touch below $12 a share, up about 2.33% right now. In my opinion, I would probably give them the benefit of the doubt, and I would consider Upwork calls here, personally. I'm not seeing many other names that you guys may be interested in. I think I looked at most of the more popular ones that are about to report earnings today after market close. And again, those are just my opinions, right? Obviously, nothing's set in stone. And we've seen situations where, we have companies come out with healthy quarters. They beat on the top and bottom lines. We were pumped about calls. And then, the company may issue a little bit of weak guidance moving forward, or they may forecast fiscal year revenue estimates slightly below analyst expectations, or even previous quarters, like we saw with a stock like Google, right? They were beating earnings estimates, but we were actually dropping down the following morning at the open because of, analysts supposedly worrying about the Microsoft Azure cloud segment, taking more market share from a company like Google. So they were bringing them down instead of bringing them up, not seeing the same revenue growth and segment growth that they were expecting quarter over quarter and year over year. So we know earnings are 100% a gamble because anything can happen. So please understand the risks involved. But I'm going to end it there. We looked at a handful of stocks, and hopefully we get more right than we're wrong. And we'll try to do an update video possibly today after market close. But there was a couple of other stocks I wanted to look at, so I'm not exactly sure how many videos I'm going to be able to make today and what we're going to be looking at in total. But that's it. I'm going to end it there. So once again, stocks by their numbers. Thanks for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand markets are rocky, they're volatile, they're very uncertain. I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. And if you jump in any of these plays, best of luck to you. I wish you all well.